Hello and welcome back to Financial Market Insights for Traders. I'm Sophia, and today we are going to explore one of the most important macroeconomic debates shaping financial markets right now: hard landing vs soft landing. If you follow financial news, central bank commentary, or market analysis, you've probably heard these terms mentioned again and again. Analysts debate them on television, economists write about them in research reports, and traders constantly try to figure out which scenario markets are pricing in. But what do these terms actually mean? And more importantly for traders and investors, how do markets interpret the signals that suggest whether we are heading toward a hard landing or a soft landing? In today's episode, we are going to break down the hard landing vs soft landing debate in detail. We'll talk about what each scenario means, why central banks care so much about it, how different financial markets respond to these possibilities, and which economic indicators traders should watch to understand what markets might be pricing in next. Let's start with the basics. The idea of a hard landing vs soft landing usually comes up when central banks are raising interest rates to fight inflation. When inflation rises too quickly, policymakers respond by tightening monetary policy. They increase interest rates and reduce liquidity in the financial system in order to slow economic activity. But here's the challenge: slowing the economy without damaging it is extremely difficult. A soft landing occurs when central banks manage to reduce inflation while still allowing the economy to grow, even if that growth slows down. In a soft landing scenario, inflation gradually returns to target levels, unemployment remains relatively stable, and businesses continue to expand, just at a slower pace. A hard landing, however, is what happens when the tightening process goes too far. Interest rates rise enough to significantly reduce borrowing, spending, and investment. Economic growth contracts sharply, unemployment rises, corporate profits fall, and the economy may enter a recession. Because monetary policy works with long delays, central banks cannot always see the full effects of their actions in real time. Rate hikes today might not fully impact the economy for a year or even longer. That uncertainty makes it very difficult to calibrate policy perfectly. And that's exactly why markets spend so much time debating hard landing vs soft landing outcomes. Let's look more closely at what a hard landing actually looks like in practice. A hard landing is typically characterized by a rapid deterioration in economic conditions after a period of strong growth. When interest rates rise sharply, borrowing becomes more expensive for households and businesses. Mortgage rates increase, which slows housing markets. Corporate borrowing costs rise, which can reduce investment and hiring. Consumers may cut spending as credit card rates increase and economic uncertainty grows. Over time, this slowdown spreads across the economy. Businesses may start reducing costs by cutting jobs. Consumer confidence may weaken. Corporate earnings may begin to decline across multiple sectors. Credit conditions may tighten as lenders become more cautious. Financial markets often react quickly to these developments. When investors begin to worry about a hard landing, they tend to reduce exposure to riskier assets. Equities may become more volatile. High-growth companies may see sharper declines. High-yield credit markets may come under pressure as investors demand higher compensation for risk. At the same time, investors often move towards safer assets such as government bonds, defensive sectors, or other traditionally stable investments. Now let's contrast that with the soft landing scenario. A soft landing is essentially the outcome policymakers hope to achieve. In this situation, economic growth slows enough to reduce inflation, but it does not collapse. Instead of a sharp contraction, the economy experiences a gradual cooling. GDP growth slows but remains positive. Employment levels stay relatively stable. Inflation begins to moderate as supply and demand come back into balance. Consumers continue spending, though perhaps more cautiously. Businesses continue investing, though maybe at a slower pace. In a soft landing environment, corporate earnings may still grow, even if that growth rate declines from previous levels. The challenge is that achieving this balance is extremely difficult. Central banks must raise interest rates just enough to slow inflation without triggering a sharp drop in economic activity. Because policy operates with delays and economic conditions can change quickly, Even small policy mistakes can push the economy from a soft landing into a hard one. That uncertainty is exactly what financial markets are constantly trying to assess. So, why do markets care so much about the hard landing vs soft landing debate? The answer is simple. Different economic outcomes lead to very different investment environments. Let's start with equity markets. Stock markets tend to perform better during soft landing scenarios. When economic growth continues, corporate earnings remain stable or continue expanding. Investors remain confident, and capital continues flowing into equities. In contrast, when markets begin to fear a hard landing, stocks often become more volatile. Investors start pricing in weaker earnings and slower growth. Certain sectors, especially those sensitive to economic cycles, may come under pressure. Growth sectors like technology and consumer discretionary companies can be particularly sensitive to changes in economic expectations. Bond markets also provide important signals about the hard landing vs soft landing outlook. Government bonds often act as a safe haven during times of economic uncertainty. When investors begin to fear a recession or hard landing, demand for government bonds may increase, which can push yields lower. At the same time, bond markets often start pricing in the possibility that central banks will eventually cut interest rates to support the economy. One of the most closely watched indicators in bond markets is the yield curve. When short-term interest rates rise above long-term rates, the yield curve becomes inverted. Historically, yield curve inversions have often preceded recessions. Credit markets provide another important perspective. Corporate bonds typically offer higher yields than government bonds because they carry additional risk. When economic conditions are stable and investors are confident, the difference between these yields, known as the credit spread, tends to remain relatively small. But when investors begin to worry about economic stress or rising default risks, credit spreads widen. This widening often reflects increasing concern about corporate financial health during economic downturns. Currency markets also react to changing economic expectations. If investors believe a country's economy will remain resilient while others weaken, capital may flow into that country's currency. Conversely, if recession risks increase and interest rate cuts become more likely, a currency may weaken as investors seek stronger growth opportunities elsewhere. One of the most important things traders need to understand is that markets do not usually price in a single economic outcome. Instead, markets price probabilities. For example, investors might estimate there is a 50% chance of a soft landing, a 35% chance of a mild recession, and perhaps a 15% chance that growth remains stronger than expected. These probabilities constantly change as new economic data becomes available. Key indicators that influence these expectations include inflation reports, employment data, GDP growth figures, consumer spending patterns, central bank communications, and corporate earnings results. Even small surprises in these data releases can significantly shift market expectations because they affect the perceived likelihood of different economic outcomes. Another important point to understand is that markets often send mixed signals. At times, equity markets may rally on optimism that the economy is stronger than expected, while bond markets simultaneously signal concerns about future economic slowing. Commodity markets may reflect weakening global demand even while certain equity sectors continue rising. These contradictions occur because different asset classes focus on different aspects of the economic cycle. Equity markets tend to focus on earnings growth and liquidity conditions. Bond markets often focus more heavily on inflation trends and monetary policy expectations. For traders trying to interpret the hard landing vs soft landing debate, watching several key indicators can be extremely helpful. Labor market data is one of the most important signals of economic health. If hiring slows gradually but unemployment remains low, that may support the soft landing scenario. Rapid job losses, however, could signal a shift toward a hard landing. Inflation trends are also critical. Persistent inflation may force central banks to keep interest rates high for longer, increasing the risk of economic damage. If inflation declines steadily without significant economic disruption, the chances of a soft landing improve. Corporate earnings reports provide direct insight into how businesses are performing. When multiple sectors report declining profits, it may signal that economic momentum is weakening. Consumer spending is another major driver of economic activity. Strong retail sales and stable consumer confidence often suggest economic resilience, while sharp declines can indicate rising recession risks. For traders and investors, navigating the hard landing vs soft landing environment requires more than simply reacting to headlines. Successful traders develop a macro framework that helps them understand how different economic signals interact and how markets respond to those signals. Having the right tools can make a huge difference in this process. If you're looking for a world-class, cutting-edge, user-friendly trading platform, you can explore crystalballmarkets.com/platform. To see how advanced trading tools and market insights can help you analyze macro trends and execute trades more effectively. And if you want to deepen your understanding of trading, investing, macroeconomics, and global financial markets, you can also check out the podcast at rss.com/podcast/crystalballmarkets. It's a beginner-friendly podcast covering trading, investing, macro trends, and financial market analysis, designed to help traders build the knowledge they need to navigate complex market environments. Learning consistently and staying informed about macro developments can make a significant difference in how effectively you interpret market signals. To wrap up today's discussion, the hard landing vs soft landing debate is likely to remain a central theme in financial markets whenever inflation rises and central banks begin tightening policy. Because economic conditions evolve constantly, markets are always adjusting their expectations. For traders and investors, the goal is not to predict the future with perfect certainty. Instead, it's about understanding how markets are pricing different probabilities and adapting strategies as those probabilities change. By paying attention to key economic indicators, analyzing signals across multiple asset classes, and staying informed about macroeconomic trends, traders can position themselves more effectively in uncertain environments. And ultimately, the traders who tend to succeed are not necessarily the ones who predict every economic shift correctly. They are the ones who understand how markets interpret economic signals and who adjust their strategies as the macro narrative evolves. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.